go back now to our esteemed panel. Steve is still there. We still got to look through it. By the way, I'm trying to recycle the internet so I can compare the two. Francis, your immediate take on this decision?
Well, hearing about that dot plot, maybe it'll come in defense of the dot plot. There'll be a lot of comments about this being very political in nature, but this wide dispersion in views on this Fed.
The Fed wasn't political.
Well,
it's independent.
It's independent. Let me just say, because there's going to be questions about this, that there is a lot of confusion about the state of the U.S. economy now. It's not clear how much should the labor market truly be weakening. When will tariffs come through? And some of this dispersion we might be seeing in dot plots, some of it, not all of it, may very well be a reflection of the confusion of this economic moment. So we have to be careful about taking any headlines about the median dot here from what I'm hearing, because we have huge dispersion within Fed members. This is going to call more attention into absolutely who is going to be at the Fed and who is going to be leading the Fed not too many months from now.
I think this is actually really important that there was only one dissent. Because what that tells me is that even though Governor Bowman, Governor Waller may want the job of Fed chair, they're not willing to go against the consensus of the Federal Reserve in order to get that. I think that is a very, very positive statement. So, I think, Jay Powell is Mr. Consensus. He wants to get consensus. Clearly, he talked to everybody before this meeting. And to me, the fact that they're not going to fall over themselves to say 50 basis points now, even if they want more Fed easing, I think that's a very positive sign, because it says the Federal Reserve as an institution regards its independence as tremendously important, and they're not going to fall over themselves to do what the administration wants right now. And I think that's a very positive sign.
But our job, Jim, here is to look ahead. And if we are to assume that Stephen Byron or somebody else may become the next Jerome Powell, and that person is incredibly dovish, they want to lower rates, that maybe they are not entirely apolitical. What does that mean for bond markets? What does it mean for stock markets?
So ultimately what we have to think about is the framework that the Fed is working through, which is the Phillips curve. So effectively...
What is that?
So the Phillips curve is a relationship between unemployment and wage inflation. So if the unemployment rate is going up, wage inflation and therefore consumer inflation is likely to stay relatively low. If the concern is that the labor market's going to weaken, then they are very likely to be able to say, I'll look past 3% inflation today because it's not going to be a problem because the unemployment rate will be very high. So therefore, we might as well cut. That plus the balance sheet, which I mentioned before. What it means for markets, though, is that you're seeing now wage inflation stay relatively low and likely to stay low, which means that margins, profit margins, are likely to be higher. You're already seeing productivity start to rise. So essentially, as I tease through these statements and these numbers and everything else, what this is telling me is that productivity is likely to start to move higher into 2026. It's already doing so in 2025. That means markets can support a higher multiple, and it's bullish for the equity markets in that sense, because higher productivity means growth with relatively lower.
Okay, speaking of the equity markets, a couple things I want to quickly hit and then get reaction to it. The macro, the bigger markets, not moving a whole lot. S&P 500 up 0.1%. Who cares? What is moving is the small caps, the SML Small Cap 600 Index. We don't talk about it a lot. It's up 2%. Here's why I'm talking about it, Francis, because small cap stocks, domestic American companies, almost entirely all their revenue is in the United States. Those stocks tend to move at the later end of a rate cut cycle. So I want you to comment on that move as well. And here's the other news. The 10-year yield didn't move at all. It's at exactly 4%. It moved down 1/100th of 1%. In other words, if you're out there looking for mortgage relief, you're thinking, let's wait and buy a home because mortgage rates are going to come down. The bond market is saying you might be out of luck.
Well, you have two issues in play here. One is that this market already priced in pretty significant easing from this Federal Reserve. So today was just meeting the expectations already in the market. You're going to have to out-ease those 5 cuts that were already put in if you want to see additional support coming through. But the second is, we've talked about it on this show before, we've got fiscal dominance in play, and that long end of the curve where mortgages are more tied, in fact, fully tied, far less sensitive to what the Federal Reserve is doing and much more to what government is doing and what Washington is doing. So we maybe want to pay attention more to shutdown risks, budgets coming through if we want to focus about mortgage rates than we do necessarily the Federal Reserve.